Whole life was designed for death benefit, not retirement. In this episode, I'm going to answer the question, is whole life insurance a good investment for retirement? Well, it could be, but it's a far cry from the best way to prepare for retirement because it was not designed for that in the first place. Get ready. I'm going to enlighten you on what whole life is good for versus what types of insurance policies are designed best for retirement and predictable income. So my name's Doug Andrew, and I've been a financial strategist, a retirement planning specialist for more than 46 years. I've had an insurance license since 1974, and I've helped thousands of people understand the difference between term, whole life, and universal life, which was the brainchild of E.F. Hutton back in 1980. And they designed that primarily for all kinds of financial goals. In fact, on the state insurance exams that are administered, one of the questions says, what can universal life be used for? And the correct answer on that exam is the possibilities are unlimited. But with whole life, it doesn't perform near as well because whole life was primarily designed for death benefit. So let me explain why and how. And if your goal is to be able to maximize your retirement, could you use whole life insurance as a supplement to give you some money in retirement? The answer is yes. But the rate of return, the cash payout, the predictable income is very small compared to what the same amount of money in a maximum funded universal life can generate. So I'm going to explain the difference. And to be honest with you, universal life generally can produce about double the payout or double the income that a whole life policy can generate with the same amount of cash value in the policy. So when you structure a life insurance policy, if you're trying to build up equity in that policy, it's called cash value. You can do that in whole life insurance, but the whole life chassis, you have tracks that you have to go down in order to have those guarantees that the death benefit will be there your whole life and it won't lapse. And so there's a certain amount you have to put into that. If you do not, then it can jeopardize those guarantees because people primarily were using whole life insurance up until 1980 for death benefit. That is what it was designed for, is death benefit. So it's okay to do that, but that excess money in a whole life policy, you're overpaying premiums the early years to be able to underpay the later years. That builds up equity or cash value, which you can dip into. But if you dip into it very fast or greater than the actual rate of return being credited to the cash value, you can be in danger of depleting that whole life policy. And so I had a whole life agent, one of the top in the country with one of the top companies. This was Northwestern Mutual. And at the time he came through my training back in 2005, Northwestern Mutual was touted as having the best dividend paying history, and he was using projections of 8%. And I asked him, so what is the internal rate of return on the premiums that are paid into a whole life policy by the time you're 65? He goes, 8%. I go, no. Internal rate of return. That's net after the cost of the insurance. He goes, I don't know. They never taught us how to calculate that. It's actually pretty easy. It's a complicated mathematical formula you have to have a calculator for, but you just add up the money that you put into the whole life policy in premiums, and you look at the cash value that it has at a given point in time, like age 65, and then you ask the calculator, what was your average net rate of return after all costs to equal that cash value? And he had to go until age 95 before the internal rate of return was 5.95% on an 8% dividend paying whole life policy. Meaning he had to earn 8 to net not quite 6, but it took till age 95. People have been retired 30 years at that point. So I said, show me the best income you can take out of the whole life policy without it crashing and burning based upon even those dividend rates. And on $1,000,000 of cash value, for example, it was only like $40,000 or $50,000 a year. Now, many whole life policies are only crediting maybe 4 or 5%. So if a whole life policy, if you ask the whole life agent to illustrate income, because whole life wasn't designed really to create the highest amount of income, they'll be lucky to show you maybe 4 or 5% payout. So on $1,000,000, that'd be 40,000. Maybe 50,000. With universal life, you can get away with less insurance. You can keep that cost down. You can put in the money faster, and you can put in more money. And if you structure it and you use indexed universal life like I do, I've earned average rates of return of 8 to 10%, but pretty much a no-brainer, 6%. So 6% is a lot better than 4. How much better? 50% more money. On $1,000,000, that's 60,000 instead of 40,000. But we've had many, many clients for years who have been able to pull out 8% and even 10%. What's 8% on $1,000,000? 80,000 of tax-free income without depleting principal, because that was their net internal rate of return. They were actually earning 9 and netting 8. 80,000 is how much better than 40,000 out of the whole life policy. It's double. It's 100% more income. At 10%, how much better is 100,000 than 40,000? So see, a max funded universal life policy will generally outperform a whole life policy by maybe double, but when you use indexed universal life, then you can participate. And people say, well, what about the cost of universal life? If you maximum fund it properly, in about 15 years, you'll no longer have any cost of insurance because your cash value equals or exceeds the original death benefit. You are self-insured. Why do you need to have cash value guaranteed in the policy that it won't lapse if the actual cash in the policy exceeds the death benefit? Now you're self-insured. You don't need guarantees because you are self-insured. That is the brainchild of E.F. Hutton behind the emergence of universal life. You wouldn't believe how many insurance agents do not understand what I just explained to you. So let me connect the dots. So when we talk about the purpose of an insurance policy, whole life is primarily for death benefit. Can you dip into it to help you in retirement? Yeah, but your rates of return, your payout might only be 3 or 4%, maybe 5% at best. If you have the same cash value inside of a max funded universal life, not only within 15 or 20 years, if you maximum funded it in the first 5 years, which the IRS will allow you, not only will you then have the cost of the insurance become cheaper as you get older, because frankly, you're self-insured. When I start out with a universal life policy with $500,000 of contributions in 5 years, the minimum death benefit, if I made 60, is $1,250,000. Well, pretty soon my 500,000 of cash doubles to $1 million, and that doubles to $2 million. Within 15 to 20 years at the rates of return I've had, my cash exceeds the original death benefit, and my option is, hey, then I am self-insured. The insurance company is only charging me for the net amount of risk, and if it's next to nothing, the insurance gets cheaper as I get older. I don't need any guarantees in whole life. If I funded universal life for retirement as my primary objective, or as the insurance exams say, it can be used for unlimited purposes, for business working capital, college funding for kids, real estate management. There's all kinds of ways that you can use universal life. That's why it's called universal. It's universally applicable. And so when you do that, you're able to earn rates of return usually at double the payout if it's for retirement that a whole life policy can generate. If you want to learn more about this, a max funded universal life, indexed universal life is my preference. I call the laser fund, liquid assets safely earning returns. So the answer to the question, is a laser fund an indexed universal life insurance policy? Yes, but it's how you structure it and fund it that makes all the difference. You can't just buy an indexed universal life policy and have it perform the way I'm talking unless it's structured correctly. So to me, a laser fund is a properly structured and maximum funded insurance contract in compliance with 3 tax citations, TEFRA, DEFRA, and TAMRA. And that way your money accumulates tax-free under Section 72E of the Internal Revenue Code. You can access the money tax-free for retirement or any goal under Section 7702. And when you ultimately die, it blossoms and transfers income tax-free under Section 101A. That is the beauty behind that. And so that's why I call it the Laser Fund. Liquid Assets Safely Earning Returns is the acronym. So if you want to learn, I want to gift you a copy of this 300-page book. You can pay $20 retail, but you know what? I'll gift it to you. You simply go to laserfund.com, L-A-S-E-R fund.com, and contribute $5.95 towards the shipping and handling. I'll cover the rest, and I'll buy the book. And there are all kinds of charts, graphs, and explanations in here, and also 62 actual client stories. And you can see why this is one of the preferred vehicles for retirement on a tax-free basis.